Well, the market rout that occurred in late July and early August, and the volatility in the 6 weeks after that, was caused by fear of a sovereign default and a banking crisis in Europe. This week, it's all about economic growth and fear of another recession. And that's shown by the fact that whereas the volatility of the past 2 months was led by European bank shares, this time it's commodities. Last night there were massive falls in oil futures, silver, which fell nearly 10%, gold and base metals, with copper and nickel both down 7.5%. Between February 2009 and February this year, metal prices almost tripled, and you'd have to say that that could be never justified. There was a 23% correction in May last year when the problems with Greece first surfaced, but it took off again, and now the index has corrected another 21% so far. Here's a quick view of global share markets. Europe saw some big falls because they have the double whammy of a potential bank crisis and a recession. In the United States, share prices fell about 3.5% last night. In Asia this afternoon, the worst hit was Korea, down 6%, but other markets got off relatively lightly, and so did Australia. It was down 1.6%. But combined with the sudden downturn by the Australian currency, Aussie shares have become a shocking investment for foreigners. Since September the 1st, the All Ordinaries expressed in US dollars has fallen 17%, compared with 7% by the S&P 500. Here are some of the biggest moves today. Fortescue down nearly 10%, Rio and Newcrest 4% each. Most of the banks fell, but would you believe Commonwealth went up 1%. Finally, the Aussie dollar, at last some good news. It's well below parity. At one point today it was 97.25, now 98.25. And that's finance.